All right, letting people in. Hi, Lisa.
Muted. So a lot of black screens today.
Yeah, I know a lot of people are camera shy.
I just put a hat on.
I think it's because of COVID. People just, they're not getting dressed in the morning. They're just kind of rolling out of bed over to the computer. I'm
I did
guilty of that.
shower.
I
I didn't
throw a
wash
hat
my
on a
hair.
lot of days. Some days, even if I take a shower, I throw a hat on because now we have COVID hair, right? There, Susan turned her camera on for us. We'll see how many other people we can shame into turning on their cameras. Kids today. All right, looks like we got most everybody in here. We'll give it another couple minutes to let people trickle in. Apparently this was a hot topic. There's Jill.
Few more
Kendra.
cameras. Yeah.
And Elaine came right in with her camera on. She's not camera shy.
Oh, there's Kelly.
Kelly. Yep, see, we made people feel guilty.
We're pulling them all out of the woodwork.
That's right. Wait, we got a few more people to let in.
Wow, this is a good turnout.
Yeah, it's a hot topic. Plus, I actually took the time to tell people about it for a change instead of just counting on people going to my site and finding out what I'm doing.
Just out of curiosity, Steph, would dividends be a conversation you would talk about because it's Canadian?
Dividends?
Yeah.
Well, I mean, dividends are a U.S. thing too, but it sounds like there's something specific about Canadian accounting that you're referring to.
Well, I have to pay myself dividends this year, and I haven't done it yet. So it would be a topic to, like, I was going to put it in the notes, and then I took it out saying, no, it's Canadian. So because it'd be different markups and stuff like that, right?
But I might need your help understanding exactly what dividends means in Canadian accounting, because in the U.S. dividend, it's really no different, especially if we're talking about a small business. It's a distribution, right?
Right, paying out the capital, right?
But I've never heard of a situation, and again, that's like you say, this is probably where it's a Canadian thing. I've never heard of a situation where one had to pay out dividends. If anything, we have the opposite problem in the U.S. where people take too much in distributions and don't pay enough payroll, like for an S corp, right?
Right.
So, I mean, if you have to take distributions, I assume there's some formula that shows you how much you have to take out. And I don't know what do you mean by a markup on a distribution?
It's on our T5 slip is what we, I don't even know how to compare it. Yeah, so not to worry. I just have to.
Just move to the United States and it'll all go away.
Yeah, okay.
I don't know. I love Canada and I love
joking.
Canadians.
Right?
Look, lately, Canada's looking better and better compared to the U.S., that's for sure. Anyway, I'm always happy to entertain any topic, but something like that, I may need your help understanding, some of the nuances, and then
What
I
I'm
can probably
asking,
translate that into the accounting, because that's how I learned and actually have worked with a lot of Canadian companies over the years. Is the biggest thing that I had to figure out, I remember years ago, is GST and HST. I was like, okay, so it's kind of like sales tax, but there's a few differences. And so little by little, I was able to kind of piece it together and figure it out.
No, I just thought I'd ask. No biggie.
And that's how I've learned most of what I've learned, honestly, is by throwing myself into the lion's den and just figuring it out.
Right? That's what I have to do. It's
just say, all right, well,
like the next person, I never have time, right?
Yep. You take on a client, you say, well, I don't know how to do this yet, but now I'm going to figure it out.
You don't tell them that.
No, of course not. Of course not. And that's why I love charging flat fees, by the way, because if I'm charging by the hour to learn on the client, that's not fair to the client, right? But charging a flat fee, I can learn all day. It'll just take me longer to do it at first, right? So I'll put in the extra hours, learn what I need to learn, scale it down, and over time it works out well. And I've learned that understanding the accounting fundamentals, truly, I can usually listen to an owner explain their business to me, and I can think through what the accounting needs to look like on that. It's been a long time since I've been stumped. Let's put it that way. Just because I've learned how to think through fundamentally what needs to be done on the accounting, which actually kind of brings us to today's topic and a little bit of where it came from. Because let me just look at the chat. My attorney advised me not to be on camera. Okay, fair enough.
Oh.
We've got a famous person here in our midst. And then, and Lisa was responding to that. Okay. Anyway, so that's kind of, it's a little bit of where this comes from, because as I mentioned, I don't know how many of you actually read the description that I wrote about this, but opening balance equity has been a very big problem in a sense for many years, because on the one hand, it's like we kind of need it, right? We're working with a client, let's say, and the client says, hey, I've had this personal credit card I've been using for personal stuff, but now I really want to use it in the business because I want to get the points. And so we maybe even somewhat reluctantly say, okay, I'll put it on the books, but now you got to stop using it for personal. And then we got to set up that beginning balance for that credit card for whatever it was, effectively transferring that liability over to the customer and burdening their balance sheet with it. And so as the offset, we use opening balance equity. But it's like, then what happens? Now we have this opening balance equity item, which either sits there in the balance sheet forever, or what most of us end up doing is closing it out to retained earnings. But I've grown to hate that, and I'll explain why. And then I'll explain what the solution is that I've come up with for it. And so far, everybody that I've done this with has really liked my proposed solution for how to deal with this. Because at the end of the day, and also, by the way, what's happening is with QuickBooks Desktop, it used to be I could drill into the retained earnings account off the balance sheet, and I could see the list of transactions, which in a perfect world is one transaction every year closing out net income to retained earnings, right? And it's on December 31st. We're assuming a calendar year, of course. And what I'm sort of driving at here is, at the end of the day, that's all I want to see in retained earnings. I just want to see that one yearly closing entry. I really don't want anything else ever posted to retained earnings. And the main reason why is because whenever I do post something else to retained earnings, it screws up that reconciliation that the tax professionals are trying to do every year, because the first thing they do when they grab a set of books is they want to look at what was beginning retained earnings, which is from the end of the last year that the return was filed for, right? The beginning of the current year, let's assume we're current. And they want to take beginning retained earnings plus net income from this year equals ending retained earnings, right? And we know half the time it doesn't match, right? And so that was why years ago I developed my whole trial balance adjustment template that I think a lot of you have actually used, that helps you force the books back into agreement with the tax return, and then we want to keep it there, right? And so, and I was just looking at this with a client last week or the week before, which is what made me decide to do this topic today specifically, which is we ran a report that I'm going to show you today. We're going to spend a lot of the rest of the hour of today looking at this report that I'm going to look at with you, that looks at year over year the retained earnings account in a P&L. So you take a P&L and you run it for all dates and group it by year. And you do that to kind of see how that ties into the retained earnings section in the balance sheet. And when you run those two reports, and I'm going to show you, you want to be able to see that each year's net income on the P&L accumulates and matches exactly what retained earnings says in the balance sheet. But the minute I close something out to retained earnings, it screws up that process. It no longer, then I get this weird beginning balance that doesn't flow over from, the formula that I want for the previous year's ending balance. In other words, like I said, I want retained earnings to equal last year's retained earnings plus this year's income, period, income or loss. That's it. And so I said, well, the solution then has to be for something like opening balance equity. It can't go on the balance sheet. It has to go on the P&L. And so that's your hint. And I'm going to show you everything I'm talking about and exactly what I mean. By the way, Lisa, I've made you a co-host if you don't mind letting people in for me, because once I start sharing my screen, I will not be able to focus on that. And that should help with that. Thank you. So let me kind of dig in and show you exactly what I'm talking about. So over here, I'm going to go into this, my sample company. And so right now we're starting with a blank, which just makes this really clear and easy to see. So we'll start off with balance sheet. And I'm going to duplicate the tab so I can run the P&L in that one. Meanwhile, this is going to be for all dates, right? And I'm going to run the report just to kind of show you there's nothing in here. There's from previous iterations where I've used this company file in videos I have. And this is another thing that I despise when you set up an inventory item And if you don't pay attention, it creates that starting value and posts it to opening balance equity, right? So I've zeroed it out since, but you can't delete this transaction, which makes me absolutely nuts. Normally I would want this just deleted and out of here, but it doesn't let you do it. The result, when I run my balance sheet, even though I've gutted everything out, I end up with this phantom $0 inventory asset item and the corresponding phantom $0 opening balance equity. This kind of stuff just bugs me. It's my OCD, but I think it's what helps make me better at my job, especially when it comes to accounting. I hate seeing this stuff. Nothing I can do about it here. But what I'm going to show you today will be exactly a way that you can prevent from this kind of thing ever happening or coming up. So let's say that I come over here to the profit and loss. Again, all dates, run it. So again, no tricks up my sleeve. That's the balance sheet. All right, so again, profit and loss, absolutely nothing. All dates, nothing shows up. So now, let's say that, all right, so let's say perfect world. We're gonna go back to 2019. We'll say we started the business, right? And I'm gonna start the account off. Let's go. Let's say I started the business on New Year's Day, 2000, we'll do it 19. Actually, let's do it back to 18 because I want to be able to show a progression of several years on this. In fact, let's go to 2017. Do I hear 2016? Just kidding. We'll stick with 2017. That gives us a good few years that we can see because I really want you to get the visual on this when I get there. Okay, so I'm opening up my business bank account. It's day one. What other accounts do I have in here? I have some other stuff. All right, so we'll stick with Wells Fargo 5678. And obviously, if this is the account opening deposit, I should never use opening balance equity for this because I already have something I'm going to use called shareholder contributions, right? I'm contributing money into the bank account of this business. So it's definitely contributions. It is not opening balance equity. I should never use opening balance equity in the first place unless I absolutely have to. But today I'm going to show you why you'll never have to use it again. So let's say we open this up with $100,000. Okay, so we start off nice and clean. Save and close. Yep, I'm sure. All right, let's go back to the balance sheet. Now it's got 100K in it. Okay. And now we're going to run this all dates and total by year. Boom. And you're going to start to see how this kind of takes shape. Profit and loss, also all dates totaled by year. Obviously, nothing's happened on the P&L yet, so that's not going to change much. Okay, that's very simple. No opening balance equity. This is exactly the way it should be. I put 100,000 in the bank. That shows up properly as a shareholder contribution. And you're going to start to see how I like to design the equity section of my balance sheet, where each owner gets their appropriate account for capital. So if it's a corporation, obviously it's shareholder. If it was an LLC, it would say member, right? The nomenclature changes slightly, but the structure doesn't. So we have contributions. We're also going to have a distribution sub-account under here so that I can keep them separate. This is just me. You don't have to do this. But I like to see it this way so I can very clearly see on a permanent and cumulative basis how much we've put in year over year and how much we've taken out, right? Because what usually happens is we put money in the beginning and then they start going and making money and then they suck it out in distributions instead of leaving money in the business and actually investing in their own company, heaven forbid. So I like to see that whole picture. I've encountered a lot of situations where people tell me that the CPAs that they work with on their clients want to close out this equity section to retained earnings. I'm going to say, no, don't do that. It's going to skew the picture and I'm not going to be able to see what really has gone on here on a permanent and cumulative basis. I will never close it out to retained earnings. If a CPA asks me to and really insists on it, first I'll fight them tooth and nail on it. And then eventually what I'll do is I'll post the entry on December 31st and reverse it on January 1st just to shut them up, right? I do not like the idea of closing out the shareholder capital section to retain earnings. I think it's a terrible idea, and I think it's not the right way. My opinion, of course. So now let's get some income on the books, okay? So let's say we have our first invoice. Okay, we have some customer. Okay, and this is going to be, let's just say we got our first business in 5 days later. Okay, and then we'll just do some consulting here for $10,000. It's non-taxable. Save and close, and yes. Oh, I'll just uncheck that. Okay, now I'll click run report, and it is not refreshing because this went back to this year to date. All right, perfect. So now I go back to running it for all years broken out, or all dates broken out by year. So now I have some sales, no expenses, net income, right? We're always talking accrual basis here, right? The only reason for cash basis is to file a tax return. Other than that, I need to be on an accrual basis to analyze a business properly. Cash basis tries to eliminate too much from the picture and gives me a skewed look at what's really going on, right? So when I'm analyzing a business, it always has to be on a cash basis. So look what happens here. I have net income in year one of $10,000, right? I have my contributions here, so that stays in the contribution section. And then, of course, right in year two, my net income flows over to here. Okay. Let me post an invoice in January of year two here so we can start to see what this looks like. So some customer comes back. It's a year later, maybe a year and a week later. And he says, I was so happy with what you did for me a year ago. I'd like to do some more consulting. This time we're going to do it for $15,000. Yeah. I might have to just put a dummy email address in there to fix that. It keeps resetting my P&L, which makes me crazy. That's okay. Hi, Mario. All right, then. I should probably turn off Slack for now. But anyway, so I have $10,000 that I made in year one, another $15,000 in year two. I'm keeping it simple. Of course, there'd be expenses, but I just want to see, I want to illustrate clearly the flow that we have, right? So in year one, my net income was 10,000, year two, 15. Let's go back to the balance sheet. Okay, so here I'm in year one. Year two, that flows over to retained earnings, right? Year two, I make 15,000. That flows over to retained earnings and accumulates. So do you see how nice and clean this is? Because I can look at each year's P&L and I can say, okay, 10,000 year one, 15,000 in year two. My cumulative on the balance sheet as of now should be 25,000. And I can come back over here and I can easily see that, right? And this is how I want to keep it. In other words, I don't want to touch retained earnings ever. I just want this to be the whole flow. Whatever the bottom line net income number is what's going to flow into retained earnings and accumulate. So I never want to touch opening balance equity ever again because I want this visual to be really clear. I was doing this with a client the other day because they were trying to understand the equity section of their balance sheet. And all of a sudden, the retained earnings number for one particular year did not equal the prior year's retained earnings plus that same prior year's net income. There was a difference when you did the math. In other words, if that were the case here, I would take the 10 plus the 15 equals 25. I wasn't getting 25 here. I was getting something more than that. And one of the problems specifically with QuickBooks Online is I have no way to drill in this retained earnings number to find out where that was coming from. Okay, what I was ultimately able to do, and pay attention here, because you're going to need to know how to do this if you don't already, is I was able to do a search. Okay, at the line item level. So hold on, where is it?
I think you need to change it to amount on the top, yeah?
Yeah, amount, line, or total. No, I don't want amount. I want account. And why isn't it letting me search? Oh no.
If you do amount on transactions, won't it give you that option to do all lines? No?
Oh, duh. All transaction lines. Thank you.
Yeah.
And then I want line account. That's what I needed to do. So all transaction lines and then line account equals retained earnings. And using a search like this, if there was anything other than that closing entry, it would show up in this result. And that's how I was able to figure out what was causing the problem. And it was exactly that. It was an opening balance equity entry that got closed out to retained earnings. And so it was throwing off my number in terms of the way I wanted to be able to analyze it. Is it wrong? No, it's not technically wrong, right? Because all we're doing is moving money around the equity section of the balance sheet. So it's not technically wrong. But again, what we're here to talk about is the difference between not technically wrong and bulletproof, right? I want my books bulletproof. I want it to be, I mean, look how much cleaner that is. If I go back to my report, when I can clearly see the flow of net income closing out to the equity section and then closing to retained earnings and then flowing, you know, on a cumulative basis each year, right? This makes it so clean. So I don't want to move something from opening balance equity into retained earnings. Yes, I can look at this for another second and kind of figure out what happened. But like I said, especially when QuickBooks Online itself doesn't make it easy to drill into what the changes to retained earnings were, I'm even more motivated not to touch the retained earnings account. And if I can come up with a system that helps me avoid doing that, then I've got exactly what I want. I've got a bulletproof equity section in my balance sheet, right? Also, just to give you more of the picture of what the shareholder capital thing looks like, let's throw some distributions in here real quick. So we'll just write a check. In year 2, we'll say, oh, we've got another 15,000 here. So the check would be me. I don't think I'm in here. Call me a vendor, doesn't matter. Distributions. And I'll take 2,500 out. All right, when I do that, now you can see how nicely this lays out, right? Because it shows that I contributed 100,000, I took out 2,500. So the net value of my capital in this company is 97,500, right? If I really wanted to be thorough, what I could actually do, instead of posting things to retained earnings, I could actually close retained earnings out to my capital account here. Which, by the way, if there's 2 or more shareholders or stakeholders, and especially if their ownership ratios are anything other than 50-50, I will do that. I will take, each shareholder will get their own capital section just like this, and I will take the retained earnings and divide it up in their share in a journal entry and distribute it among their capital accounts. And I will have that as a third sub account. So we'll have distributions, contributions, and then, you know, I might even just call it shareholders' equity under here, just to explain that that's the equity from retained earnings that I've distributed to their account. So I will often do that. So I'll take money out of retained earnings to zero out retained earnings, and I'll put it in that shareholder equity, in you know, again, in accordance with their ownership ratios. So I will go that way. And that's perfectly fine. In fact, that's the way it should be, because you really do. That's where you're now clearly able to see the exact value of each shareholder or owner's equity in that company. So what happens when in year 2, the owner says to me, in this case, I say to myself, hey, you know what, I want to stick that personal credit card on the books and start using it as a company card, but the problem is it's got a balance with it that I have to bring over. And it's fine. Again, it's not, there's nothing wrong with this, right? But we have to figure out the right way to deal with it, right? So what are we totaling by years here? Okay, so how do we do that? In year 2, I want to put a credit card payable on the books with a beginning balance. Watch how I do this. So this is the whole trick. This is the whole thing I wanted to show you today, okay? And what I've come up with. And so far, everybody who does the taxes for every client I've done this with has been really pleased with this, because one of the biggest frustrations, like I said in the beginning, that almost every tax professional I've ever talked to has is when the retained earnings don't tie. And if I throw something into opening balance equity, and then I want to close it out to retained earnings, again, it throws it off. It's not like it's impossible to figure out what happened, but again, it's just not bulletproof in my opinion. So here's what I've started to do. So we're going to first, I don't even know if I have a credit card account on the chart of accounts. Let me duplicate the tab again. I probably do. Let's go to accounting, chart of accounts. Okay, I do, because clearly I've done an illustration of what to do when you have a card with sub-accounts on it. So we're just going to deal with the credit card master. We're going to say this is the account we're setting up. So I'm going to bring over the balance onto that credit card. So we're going to create an expense. And let's say I was doing it as of the beginning of last year, right? January 2019. So we're going to put the entry on 01/01/19. I like putting these kinds of things on the first of the year as the date, right? Let me think about this for a minute. Yeah, that's fine. So we're going to put it on as of the first. And let's say that beginning balance that I need to get transferred that I owed on the credit card as of this moment when I'm making it into a company card is, let's just call it $7,500, okay? So there's a $7,500 balance. So again, this is where we'd normally be using this dreaded opening balance equity account. Here's what we're going to do that's different. And I've already got it created. It's an account that I call prior period adjustments because that's exactly what it is. It's an adjustment based on stuff that happened in prior periods. Okay, and I'm going to show you exactly how that account is set up. You might have even already noticed it when I pulled the account up. But I want to show very clearly where this is going to show up, and I want to explain why. So if I go into my chart of accounts, it's here in the other expenses section, prior period adjustments. I don't care about the detail type. You'll see I left the detail type as amortization. I could care less about this, but usually what I will do if I decide to take the time is change the detail to like other miscellaneous expense. And this comes in handy a lot when I'm doing any kind of cleanup work too. When I'm dealing with stuff from prior periods, when I have stuff in accounts receivable from 3 years ago, you know, that needs to get written off. And, you know, those situations where it's sitting in accounts receivable because they, or it's sitting in undeposited funds, let's say, because they posted the invoice, received the payment, but never deposited that payment. Then when the actual deposit came through, they just recorded that straight to income, right? And if that happened and it was 3 years ago and we've already filed the returns, we don't want to mess with that year on the books. So we basically record the adjustments using this prior period adjustments account. Now, of course, it's going to show up on the P&L. All right, so this is going to go to the credit card to get that beginning balance set up. And here's what happens, and here's why. So what it does here is it sticks it here below the line. In other words, it carves it away from the operating income. So I can still see very plainly how the company operated during the year. This is not impacting the operating profits of the company. This is called a below the line item. In public accounting, we call these extraordinary items. Extraordinary meaning they're extra, and they're extraordinary, not ordinary, meaning I never really expected this to happen, and even though it happened now, I don't expect it to happen again. And the reason I like it here is because this flows into this net income figure, which will get close to retained earnings in the natural way. In the meantime, then, it can and it should beg the question on the part of the tax preparing professional as to what this is. So, of course, I'm going to put a good little comment on the transaction, right? And I'm going to say, setting up existing credit card as a business card. And yes, of course, best practices, we all know, we shouldn't even do this. We should just open up a new credit card account. But we know that in the real world, in all practical purposes, that's not always easy. Plus, if their point is they want to get the rewards on the card, and that's why they want to start using it for the business, fine. So I'll let the client do it, but I'll make the stipulation that from this point forward, you only use this for the business and don't use it for personal, right? I have no problem with a business owner paying for personal expenses, or paying for business expenses rather with personal means, because I can just treat that like an expense report, and I've got a video on that. But the other way around, I can't accept, because that's where we're really messing with and getting into that whole realm of commingling funds. So if I'm going to do this for a client, I make the stipulation very clear that it cannot go that way. This card cannot be used for personal expenses. Of course, they'll probably do it anyway, and I'll keep reminding them. And if they do, I'll book the charge as a distribution. But I just want to make the point clear that if we're going to do this, we want to make it we want to kind of establish that ground rule with the client that you are not to use this card for personal anymore. If you're going to do this, it needs to be strictly for business. So we'll set this balance up. And we carve it out on the P&L outside of the operating profits. And then the tax professional will probably make some kind of an adjustment because obviously this isn't truly an expense, right? Nor do we want it to be. But this forces it, again, outside of the operating profits, but so that now when I run my balance sheet, I still have my flow, right? There's my net loss in year 3 of 7,500, right? There's no other activity on the books except for me putting that beginning balance on. So I started with 25,000, right? I have a net loss for the year of 7,500 based on that balance. And so when I get into the current year, it reduces my 25,000 by the 7,500, giving me 17,500 in retained earnings. So I still have that nice clean flow here in the equity section that I want. And I make this stick out like a sore thumb. In fact, I joke around that if the person doing the taxes doesn't ask me about this, then I have to question how much they're paying attention, right? But I do this on purpose, and I put a good comment on it because I want to force the conversation with the person preparing the taxes and kind of say, you tell me what you want to do with it. But I didn't want to just, stick this in the equity section like most people do, because I think it makes it messy. And again, now you can see, looking back at the balance sheet, how nice and clean everything flows. Perfect world, I'd get retained earnings to fall down below shareholders' equity, which of course we could do by renaming it, right? So that instead of calling it shareholder capital, I can make it. And again, this is just like really like OCD kind of stuff. So if I go like this, if I could type, so let's say I just kind of flip this. Capital dash shareholder. South, this would be me. Now it's even cleaner because now you got this section up here. There's your opening balance equity, which is 0. And then there's your net income. I like this structure much better because, as you can see, it's just cleaner. And now you can really see the flow, right? 10 to 10, add 15, that gets me to 25. Subtract 7,500, that gets me to 17,500. And that keeps it nice and clean. And that was essentially what I wanted to present to everyone today, is to show you. And the whole key to it was this prior period adjustments account. So I run it through the P&L instead of through the balance sheet. That's the main gist of how this works. And hopefully now I've made it clear why. But of course, I'm wondering if anybody has any questions or thoughts or concerns. Nothing? Clear as mud? Wait, Andrea, are you trying to talk to us, or we got to unmute you? I don't know if she's talking to somebody else or not.
I have a question, Seth. It's Kelly.
Yep.
I was working with somebody who has a PayPal bank account set up, but it wasn't really ever properly used that way. So the balance was never matching the statement balance. It didn't reconcile to the PayPal statement.
Mm-hmm.
And I said, let's just start at the end of this year and we'll have an entry. We're just going to line it up and start going forward.
Mm-hmm.
And so I actually entered a journal entry in last year. I used opening balance equity, and I really just used it to highlight for the tax preparer, like, what do you want to do with this? It's like $220,000. I mean, it's not a significant amount of money. Would you say that this prior year adjustment account would be a better place to stick it for now?
Definitely, without a doubt. Before you even finish the question, I was going to say that's a perfect use case for exactly this workflow. In fact, I did that very thing with a client. I had a similar issue where by the time I took over his books, the PayPal account zeroes out every day on this client. That you can call PayPal and ask them to do that. There's no way to do it on their site. You have to call, but you can call them and ask them to do that. So theirs is set up that way, and yet they had $190,000 sitting in their PayPal account on their books at any given time, fluctuating, 20,000 one way or the other. And so we knew it was, and I tried to reconcile it, and it was a mess. I couldn't reconcile it. So ultimately, when the time came and we set them up with a new set of books, and I was able to set up the right balance going into the new books based on the actual PayPal monthly statements, I did the offset exactly that way. I pushed it through prior period adjustments. And sure enough, the CPA, I'm actually sitting with the question in my inbox right now from the CPA asking me about it. The funny thing is I discussed this extensively with the CPA, but she obviously doesn't remember because I'm sure she deals with lots of clients. So I'll have to remind her that this was the adjustment we discussed that I was going to do to get PayPal right.
And what are some common ways that they will address? How do they handle it as far as cleaning it up, the books with that number? Like, what do they do typically?
I mean, I'll be honest, that's where it goes outside the scope of what I deal with, right? I kind of leave it to them.
I'm just curious. I mean, I'm just wondering, like, how do you, like, $200,000 disappear or not?
Well, let's put it this way. In theory, if I have a balance in PayPal that's grossly overstated like that, that represents money I've received.
Yeah.
Right? It represents money I've received. It may very well represent, especially if it's still sitting in there and it didn't get reconciled properly, it's either missing expenses, right? Most likely that's what it is. So the bottom line is if I throw it through a prior period adjustments and it's going to show up in the form of an expense, it's probably appropriate. It's probably because I had understated my expenses cumulatively for several years. And so now in the current year, I'm going to overstate my expenses to catch that up, right?
In this instance, it was... the expenses were, it's like that, well, a lot of it is when part is paid out of PayPal and Amex pays the other part and it shows up on the Amex account. And so it was expensed through Amex when really it was really a transfer from Amex to PayPal and the full expense was paid out of PayPal, but that was never recorded in that way.
Right. So again, you understated your expenses.
Yeah. So,
because the only expense you picked up was what was paid out of Amex, which was transferred, and that was less than the full amount.
Yeah.
So it's a classic case of what happens.
Yeah.
So we understated the expenses prior years, which means we overpaid our taxes. So we're going to pick up the expense this year. Now, what I think some accountants have done, and sometimes I'd say, like, you know what, I don't want to know. Like, do what you're going to do with it. I know I've got it set up the way I want it on the books, and I can explain it to anyone who needs to know. But I think what they'll do, because nobody wants to hit a set of books with a $190,000 adjustment. It's all relative, of course. I mean, this is a company that I'm the one I'm talking about that does easily $250,000 a month in revenue. So that kind of a hit on their books is not actually that material when you think about it.
It's like a third of their gross. So,
right.
I mean, it would be a third of whatever.
So what some accountants may do is throw it into some kind of like a deferred asset account and then amortize it over a few years just to take it out in pieces to avoid getting the attention of the IRS. I suspect that kind of thing is what they might do in a case like that. Is they want to raise any red flags, so we depreciate it basically.
Because they aren't going to want to go back and amend any returns to take into account like
that's the other route. But then you have to do all kinds of work and spend all kinds of money cleaning it all.
That makes more sense. So really, is if they get called out, it's really like, well, we didn't take all our expenses. We just whatever. So it would be less troublesome to explain, I guess, because you're not trying to like make money off the IRS in a sense.
Yeah. And in a case like what I just showed you where I'm setting up a liability on the books, it doesn't in some ways have the effect of an expense because I'm burdening the company with having to pay off a liability that didn't belong to that company before. Right? So ultimately the way that should come out is it should actually reduce the shareholder's capital. Right? If it's my card that went on the books with a $7,500 balance, what that should really look like is a distribution to me because now the company's paying off my debt. So that's really exactly what that is. And so in a case like this, when it came down to the conversation with the person doing the taxes, that's what I might be inclined to say is, look, in reality, this belongs in as a distribution, but I didn't want to throw it right into the distributions because I didn't want to. In other words, I don't want anything hitting the equity section without properly going through retained earnings. Although, now that I think about it, now that I said it out loud, that would be another way of booking the example that I showed you here, is I could have just, instead of hitting prior period adjustments, I could hit shareholder distributions and basically treat it that way and say, I'm burdening the company with my own debt, which has, it's exactly as though I took $7,500 out of the company and paid off that balance, right? It's the same exact force and effect.
That's probably what I would, I mean, I usually handle those like that. Just write down, write it against the distribution.
Yeah, the problem is it's not always so straightforward, right? Especially when there's 2 or more owners in the company. That's where it gets a little more sticky than that. Yeah. But if it's nice and clean, 1 owner, and it's that owner's personal balance that we're going to pay off with, of course, the really clean way is to actually have them take the cash out, pay it off, and then transfer a 0 balance card onto the books, right? But a lot of small business owners don't have that kind of money sitting around to do that with. So
yeah.
The other thing is what's going to happen. I use this more than any other time when I'm doing cleanup work, like I said, and where the prior year's returns have been filed, and I'm just trying to clean up old balances that don't belong on the balance sheet anymore. That's really what this is. It's a way of cleaning up the balance sheet without muddying up the equity section by running everything through opening balance equity. So I guess the moral of the story is anytime that I would be using opening balance equity, from now on I'm going to use prior period adjustments and show it as an other expense, or obviously if it ends up being negative because the money goes the other way, then it's, it has the effect of being other income. But the bottom line is I'm carving it below the line so it's not included in the operating profits, so that ultimately it will close out. Because the other thing that happens a lot when I'm doing these cleanup jobs is I'm cleaning up balances and I'm posting things going in opposing directions through that account. So even though there might be some big numbers going in there, it all washes out to a fairly small, net final number that ends up sitting in prior period adjustments, which is the way you'd be surprised how often you do end up seeing that. And it's because, there's a balance here. Like I said, if I have a big balance sitting in a bank account that doesn't belong there, it's probably because I understated expenses. It's probably because I have unrecorded expenses, that were out there. And now I close the years, I paid the taxes. And like you said, Kelly, it's either amend the returns, which most business owners aren't going to want to go to the time, trouble, and expense of doing, or post the adjustment in the current year. And then, like I said, worst case scenario, if we end up with a big hit, we can spread that out over a few years by sticking it somewhere else on the balance sheet, like an asset account, and just kind of depreciating it.
I was going to ask if you could show us how to set up like 2 shareholders and the distributions in the chart of accounts.
Yeah, sure. We have time. I can do that. So let's do it. All right, so let's go to the chart of accounts and set up shareholder 2. All right, so we will start with my new business partner, Andrea. I hope I spelled that right.
No.
What?
No, it's all right.
I always get it wrong. I know that. I know that about you. It's Carrara.
Yeah, it's like the marble.
I always do that to your name, though. That's why I said it. Okay, so we'll call this Andrea Carrara Capital. This is going to be the parent account, right? Save and new. I forgot to do the sub account. And I definitely want to use the person's name in the account name. It's just easier to find when I'm looking for it in a drop-down. All right, so now I can use my browser search and search for Andrea. And I need that other account that I did there. One tip that my friend Josh mentioned earlier this week, I think it was in our Bulletproof Slack workspace where we were talking about this, is he will put their percentages in these parent level accounts. just so it's really clear. You know, if Andrea is 75% and I'm 25%, you know, you put the percentages in there. So when you're looking at the balance sheet, it's really clear. Because let's say that's how we're going to distribute the net income. So let's do that. Andrea, I'm going to make you the majority shareholder here. I'm going to just rename this whole thing. All right, and I'm very sort of OCD about being consistent with how I name stuff in these things. And no, there's no way to automate. You would need to have formulas.
Yeah.
And yeah, that's a little much to ask of QuickBooks. All right, so again, because I renamed it shareholder capital, it's going to come in, and because my name begins with Seth, either way I'm screwed.
Yeah.
It's going to come in under retained earnings. So I'm just going to change the convention. Capital Seth.
So you see them together.
Now I'm being a little ridiculous, but again, to illustrate my insistence on consistency. And now I can just get your last name out of there so I don't have to spell it wrong. And that goes.
Now you can see it all together.
What's that?
You can see them all together.
Yeah, now it'll be all together, and that's kind of important, okay? So now let's go back to the balance sheet and just kind of see what this looks like. Well, there's not going to be anything booked to you yet.
No.
Right, but now what we want to do is we have in year 1, 2017, we have to distribute this net income, right? So really what we do is on January 1st of 2018, we do that distribution. We could do, if we do it on 12/31 of 17, we're going to end up with negative retained earnings here. So we don't want to do that. So let's just go.
So then you're wanting to get to 0 retained earnings.
Yeah, we want retained earnings should always be 0 when we're doing this sort of method of equity accounting, right? So I need 12/31/17, right? And it's going to be, we had 10,000. One of us gets 2,500, the other one gets 7,500, right? And retained earnings is going to get hit for 10,000. And we need to credit these amounts, not debit, because we're increasing our respective capital accounts and decreasing retained earnings. Okay, so now I didn't create we're going to create a new sub-account. We're going to call it equity shareholder equity Andrea, and we're going to add that in. There it is. Oh, I hate when it does that. It should just know what I want. Okay, and then this is going to be shareholders. Set. Nope. It's trying to pick up Andrea's account. I'm trying to tell it not to do that. These are some of the little nuances that drive me nuts with QuickBooks. Let's try this again. Shareholders, equity. Yeah, see. So what I'm going to have to do, because it's just not going to, it's going to keep doing that to me. So I'll just have to go straight to add new. There, save and close. All right, so what this is going to do, looking at the balance sheet before we post it, is in this year, it's going to take this 10,000 and divide it up. Andrea's section is going to show up here because for the first time I'll have something in it. She's going to get $7,500 in her shareholders equity account. I'm going to get $2,500 in mine, and that's going to offset my $2,500 distribution in a sense. So this is going to be on 1/1/18, right? Because this is, yeah. And then of course the description would be distribute, you can call it earnings distribution from 12/31/17. Save and close. And there it is there. Gorgeous, right? Capital Seth, 25. There's my contribution. There's my distribution. There is my, did I screw that up and do that backwards? I think I did. I was supposed to give you the 75 and me the 25, Andrea.
Yes, I'd like the 75 more.
I thought I'd done that. Let's fix it. Look at that.
Please, math.
All right, it's telling me to balance debits and credits. I'm pretty sure. Well, if you would listen to me when I typed. All right, let's see what that does. It should work now. There we go. Excuse me 1 second. That's a delivery I have to sign for. But study this,
Right.
talk amongst yourselves. I'll be back in a minute.
How is everybody doing out there?
Doing good. How about you?
Pretty good. Getting to the summertime. It's just nice and warm out.
Okay. So, make sense?
Yes.
Now retained earnings zeros out. Okay, and then of course we would do the same thing for the 15,000 here on 1/1 of 2019, right? So just real quick, I'll jump into the last one we did, make a copy. $2019, and this time we're distributing 15,000. So 15 times 0.75, right? All right, we got the date right, save and close, and yes.
Yeah, that's all very clean.
Yep.
You know, to show everybody the steps.
Yep, so it looks beautiful. And then this time we'd have a loss to distribute. So that's going to work the same way, but now we're going to flip the debits and credits basically. So one correction, I'm looking at the chat. This recording, because it's not the sort of members only Q&A that I do once a month, is going to be in Nerd Buzz on my website. You all have access to that. Under Nerd Buzz, you'll find Bulletproof Bookkeeping webinars and more, and that's the section it goes in because it's one of the Bulletproof Bookkeeping webinars. So there's one a month that I do that's only for people who are signed up for Bulletproof Bookkeeping. All right, so let's distribute the loss and then we'll call it a day. So again, we'll go here and we'll make a copy. And this is going to be for 1/1/20. Okay, and we have a $7,500 loss to distribute. So that's going to move over here. These are going to go here. So I have 7,500 times 0.75, 100 times 0.25. And I should have updated these descriptions, but oh well.
And Seth, I have a question about that. Since that was, in that particular instance, that loss was generated by you bringing on your credit card.
Yeah, so yeah, I see where you're going. So yeah, normally in that case, if knowing what that was and that it represented a very specific thing, then we would have distributed that whole loss to me. It really, like I said earlier, it would have come out as my distributions because it was my debt.
I just wanted to double check that.
Yeah. Yep, I was at this point just going through the motions of closing out the net income to the capital accounts, right? But that's what that would look like, assuming that was, so the way I just did that was assuming that was a legitimate loss for the company based on their actual operations. So that would be another consideration when you're doing this, is you would look at the P&L and you would want to kind of distribute the net income based on, well, you'd want to look if there were prior period adjustments on the P&L for that year. You'd want to look at that and see if and to what extent that needed to be dealt with differently on distributions, right? But if it was the normal kind of prior period adjustments where we were just cleaning up things like accounts receivable, then it would be the same. You would split it according to the ratios. So it would be treated exactly in the same pool as all the rest of the net income or loss for the year. But again, doing it this way, now we have a super clean balance sheet, right? We can see the net income here. And then it's a little harder to see because it's divided up between two shareholders, but I could see the equity accounts, 7,500 and 2,500. So I can always tie that out, right? Keeping in mind, of course, that these accounts now accumulate. So these are cumulative, right? And what we're seeing here each year is just that year because we closed out the prior years to the respective equity accounts. So I've been accused of when I've demonstrated this method of structuring the equity accounts in the past, and I've been accused of it being sort of overkill. But that's kind of the point of Bulletproof Books, you know. And I remember making that remark to the guy.
Yeah, no, this is useful for me. I have a client who has been a sole proprietor for 30 years, and he brought his son on, and they changed into an S corp. So wanting to record the son's share as 30% and the owner's 70%.
Right.
So yeah.
Yeah, I mean, I remember doing this on something like this on a Friday Zoom a long time ago, actually. And actually, it was one of my Canadian accounting friends, Elaine. It wasn't Elaine, but it was another guy from Canada that I know who was in the on the live Facebook feed commenting, saying, "This is ridiculous. I would never go to this much trouble." And it's like that to me. I more politely than this, what I said to him was essentially, you can do it however you want. But to me, this is the difference between bulletproof and compliance in terms of how I set up the books. When I set up the balance sheet like this is bulletproof. This eliminates questions. You look at that balance sheet, you look at that equity section, it's very clear exactly what's going on, and it's very easy to explain when I need to explain.
Questions people have from 5 years ago.
Yeah.
And they want you to explain something that happened, years ago.
Yep. Yep. And I'm looking at the chat. So Annette is asking about our last Bulletproof bonus class. So the Bulletproof bonus classes are just for people who signed up for the bonus program back in April. So that's totally separate from these. This is just something I've done every week that, again, is for the general public. Obviously, it's designed, at least in some way, to promote my Bulletproof Bookkeeping course. I'm hoping some people will do these webinars and see the value in signing up if they haven't already. And then the last one of the month, or the fourth Wednesday of every month, is the members only one. So that one's only for members, and that's for everybody who signed up for Bulletproof Bookkeeping. The bonus classes are for just those who signed up for the bonus program. So. And then what I'm going to eventually do is put the recordings of those bonus classes on the website in a separate section, and then probably offer it to other people who want to get the recordings. I just haven't figured out what that's going to look like exactly yet. And that's my story, and I'm sticking to it. And it's 2 o'clock, and I got to go because I got nowhere to go because it's COVID. But I do have other calls to get on.
You got a package to open.
I do have a fact. No, you know what that is? That's my new drone. I got a drone.
Oh,
I saw your face.
Wondering.
It came yesterday, and I didn't know that I had to sign for it, which, it's kind of expensive. So I didn't go to the door because I'm constantly getting, it's COVID. We get deliveries. They ring the doorbell to let you know it's there, and then they go away for safe social distancing, right? So I didn't sign for it yesterday. And then I'm like, damn it. And I'm all day pinging the UPS tracking thing. And I'm like, and then it's like they're saying, well, it's going back to the center and this and that. So finally I figured out I could go in there and ask them to re-deliver it to my address. So that's why when the bell rang this time, I was like, I got to go get it. I'm not letting it go again. So now I have to carve out time to go play with my new toy. But I'm very excited. It's a really good one. Lisa, did you see the one I got? It's the Mavic 2 Zoom one.
Nice. And is it in 4K?
Yes, 4K.
Excellent. Yeah, you'll have fun.
Equipment just to store your video, Seth.
Well, so now, of course, first I'm going to play with it and learn how to use it. But then I posted in the Facebook group not long ago that I can write it off, right? Because I'm going to use the videos on my YouTube, for my company videos that I do. I'm just going to use the footage to enhance it, make it better, right? So definitely a business write-off. And then we got into the discussion of whether it would be expensed or capitalized and depreciated. But obviously, we would fully depreciate the thing in the first year anyway under Section 179 because it's not that expensive, right? So anyway, we got into a whole accounting thing. I was like, it's a write-off, right? And all my tax friends assured me that it was absolutely a legitimate business write-off for my new toy. So anyway, the real challenge is finding the time to play with it and learn how to use it. That's going to be my biggest challenge. That's the hardship. Anyway,
I'm going to force you to have some downtime, Seth.
I've already, Lisa, I'm not even kidding. My therapist told me this was important for me to do. And so I've already sketched out time on my calendar that I'm taking off. And in between now and then, I have to learn where I can go legally to fly the thing because it's one of those that's like sophisticated. I live near an airport. I can't fly it here. I can't fly it in my backyard.
We have the same problem.
Yeah, so I have to go research where I can go legally and safely to do it. Do I still offer the bonus program? Again, I'm going to package it up when we're done with this round, and then I am going to offer it. I just don't know exactly for how much. But
Hey, Steph, Canada. You can fly it in Canada.
I can fly. I'll come up to Canada. Perfect. I don't know if Canada wants to let any United States people in at this point. We're not exactly being safe about our social distancing. Just saying.
Yeah, no, there's tons of people out now. It's a little, scary.
As if nothing happened. But anyway, that's another conversation for another day. I got to run. I'll talk to you all soon.
Bye.
Bye.
Thank you.